Imagine two very specific stocks in your portfolio. The
Hmm.
first is an umbrella manufacturing company, right? And it only turns a profit when it rains.
Right.
And the second is a luxury sunglasses brand that only makes money when the sun is shining brightly. So, on their own, each of those stocks is it's a terrifyingly risky gamble
Oh, absolutely.
because your entire financial future relies entirely on the weather, which obviously you cannot control. But what happens when you combine them?
Well, by holding both stocks at the exact same time, you have basically mathematically eliminated the weather.
Exactly. It doesn't matter if it rains, doesn't matter if it shines, you get paid either way. And that simple, beautiful concept is really the key to unlocking some of the most intimidating equations in modern finance.
It really is.
So today we are doing a deep dive into modern portfolio theory. And for those of you listening right now, gearing up for your big MBA exam, I know the anxiety you're feeling right now.
Yeah, it's a lot to take in.
You've got your corporate finance notes spread out on the table. You're staring at this wall of variance formulas and covariance matrices that look less like business and more like, I don't know, advanced thermodynamics.
It looks completely alien at first glance.
Right. And if you're just trying to memorize those formulas by rote, it feels like holding water in your hands. So take a breath. Our mission today is to just stop memorizing and start actually understanding.
Because the secret to conquering this material and acing the exam is realizing that none of this math was invented just to, create a difficult test.
Right. It has a purpose.
Exactly. Every single standard deviation formula, every correlation coefficient, it all stems from a deeply intuitive place about how human beings behave when their money is on the line.
I love that.
Yeah, when you understand the human behavior, the math just becomes a way of writing down what you already know in your gut. Basically, we're just translating psychology into algebra.
Translating psychology into algebra. That is, I think that's the perfect way to approach this. But before we get to the algebra part, we really need to understand the theoretical sandbox we're playing in.
We do.
We need to know who built this framework and the specific rules he laid down because, on an MBA exam, context is everything. If you don't know the assumptions behind the theory, you don't really understand the theory at all.
Right. The professors want to know that you understand the why, not just the how.
Exactly. So take us back to the beginning. Where did this massive paradigm shift actually start?
So the shift happens in 1952. A young economist named Harry Markowitz published this paper in the Journal of Finance, and it was titled Portfolio Selection.
1952.
Yeah. And to truly grasp how monumental this was, you really have to understand what the financial world looked like before he published that paper.
Because it wasn't like it is today, right?
Not at all. Back then, investing was almost entirely focused on picking individual winners. Analysts would just pore over a single company's balance sheet, assess its management team, and basically just decide if that specific stock was undervalued or overvalued.
So it was all about the individual asset.
Exactly. If you thought a specific railroad company was a good business, you just bought it.
So it was basically just a world of stock pickers. I mean, people probably understood that putting all your eggs in one basket was a bad idea just from, common sense.
Right, the idiom existed.
Yeah, but they didn't have a mathematical framework for exactly why it was a bad idea or how to, optimize the actual baskets themselves.
And that is the exact gap that Markowitz filled. He was the very first person to formally mathematically quantify portfolio risk.
Wow.
Yeah, he shifted the entire focus away from the individual stock and onto the portfolio as a single holistic entity. He proved quantitatively how combining different assets could actually reduce overall risk without necessarily sacrificing your return.
Which is huge.
Oh, it was revolutionary. I mean, it eventually won him the Nobel Prize in Economics in 1990, along with Sharpe and Miller. Modern portfolio theory, or MPT, is basically the bedrock of everything we do in institutional finance today.
Which means the foundational rules of his theory are pretty much guaranteed to be front and center on your exam.
Oh, absolutely.
Markowitz started with the core idea that average investors want to maximize their expected return while minimizing their risks. But to mathematically prove how to do that, he had to build a simplified model of the world, right?
He did. He had to lay down some ground rules.
6 core assumptions, to be exact. And for everyone listening and taking notes, these 6 assumptions are the strict boundaries of the Markowitz simulation. You need to know them cold. So let's walk through the sandbox rules.
Okay, assumption number 1. Investors are rational and behave in a manner as to maximize their utility with a given level of income or money.
Utility, that's a classic econ word.
Right. In economics, utility is just the technical term for satisfaction, benefit, or, well, happiness. So the model assumes every single person out there is acting with perfect, calculating rationality to get the absolute most financial happiness out of every single dollar they have.
Okay, but if people are perfectly rational, I assume they also need perfect data to act on, right? I mean, they can't make perfectly rational decisions in the dark.
You're exactly right. And that leads directly into assumption 2. Investors have free access to fair and correct information on the returns and risk of all assets.
So no secrets.
Exactly.
Okay.
Thereby creating no information asymmetry. In this theoretical model, there are no insider secrets. The CEO of a massive company and a retail investor sitting at home on their laptop have the exact same information at the exact same moment.
That's a nice thought. And that actually sets up assumption 3 pretty nicely, which is about how the market handles all that perfect information.
Yes, assumption 3 states that markets are efficient and absorb this information perfectly and quickly.
Meaning instantly.
Right. The absolute moment a news event happens, say, an earnings report drops or a major geopolitical event occurs, the market prices adjust instantaneously to reflect that new reality.
So there's no lag time.
None. There is no period where a stock is mispriced while waiting for the market to catch up.
Okay, so we've got perfectly rational people, perfect information, and instant market reactions. What about their actual psychology regarding the risk itself?
That brings us to assumption 4, which is really the psychological core of the entire theory. Investors are inherently risk-averse.
Risk-averse?
Yes. They actively try to minimize risk and maximize return. If you offer this rational investor 2 different investments, and both have an expected return of exactly 8%, but one is highly volatile and the other is rock-solid stable.
They'll always pick the stable one.
Without exception.
You know, I always think of this like a daily commute. If I have 2 different routes to work and they both take exactly 30 minutes, but one is a smooth, freshly paved highway and the other is this terrifying, winding mountain road with 0 guardrails, I am taking the highway.
Obviously.
Right. I don't enjoy the sheer panic of the mountain road. The only way you could possibly convince me to take the dangerous road is if it cuts my commute time in half. I demand to be compensated for taking on that risk.
That is a phenomenal way to articulate risk aversion. The investor does not get a thrill from volatility. They only tolerate it if the expected payoff justifies the anxiety.
Makes perfect sense.
So moving to assumption 5, it specifies the exact tools these investors use to evaluate that commute. Investors base their decisions purely on expected returns, which is the statistical mean and the variance or standard deviation of those returns.
So they aren't looking at the company's brand loyalty.
No.
They aren't looking at the CEO's charisma or how cool the product is. They are completely ignoring the narrative or the story of the stock.
Exactly. They only care about the mathematical mean and the historical variance, purely the statistics.
Got it.
And finally, we have assumption 6, which is basically just the mirror image of risk aversion. Investors prefer higher returns to lower returns for a given level of risk.
So if 2 investments have the exact same level of volatility, the exact same standard deviation, you will always pick the one that pays a higher percentage. Okay, I have to step in here on behalf of every MBA student listening who is looking at these 6 rules and just aggressively rolling their eyes.
Enough.
Let's look at the actual reality of Wall Street. Are investors perfectly rational? I mean, the dot-com bubble and the whole meme stock craze prove they absolutely are not.
True.
Do we have perfect information with 0 asymmetry? Entire massive hedge funds exist purely to exploit information asymmetry and lag times. The real market is chaotic, it's emotional, it's totally uneven. So why are we required to memorize these 6 highly unrealistic rules for a graduate level exam?
And that analytical pushback is exactly the right instinct to have. You're completely correct that the real market is messy. It's full of friction.
Yeah.
But establishing these rigid rules was absolutely necessary to isolate the core mechanics of risk and return.
Yes.
Well, think of a physicist trying to prove the fundamental mechanics of gravity. If they drop a feather and a bowling ball from a roof in the real world, the bowling ball hits the ground first.
Because of air resistance.
Exactly. So to mathematically prove that gravity actually affects all mass equally, the physicist first has to build a mathematical model of a frictionless vacuum. Markowitz is doing the exact same thing here for finance.
Ah, okay. So human panic, insider trading, people buying a stock just because of a Reddit post. Those are the air resistance of finance.
Precisely. Markowitz needed a perfectly rational, perfectly informed market to mathematically isolate how portfolio construction functions at its core.
That makes a lot of sense.
Yeah, by holding human irrationality constant, he proved the math of diversification. Once that pure baseline was established, later economists could start adding the air resistance back into the more advanced models. But you cannot understand the messy reality until you understand the pure theory underlying it.
That reframes things perfectly. So for the exam, you guys listening, do not look at these 6 assumptions as a naive description of reality. You need to memorize them as the foundational parameters of the Markowitz simulation.
Right.
Rationality, perfect info, efficient markets, risk aversion, decisions based purely on mean and variance, and a strict preference for higher returns.
Okay, got it.
Okay, so now that we understand the mindset of this theoretical investor, they want maximum return for minimum risk. The next logical hurdle on the test is figuring out how to actually calculate that return. And thankfully, the math for expected return is highly intuitive.
It really is the easiest calculation you will face on this entire exam.
Mm.
When you are calculating the expected return of an entire portfolio, you are simply calculating a weighted average.
Just a weighted average.
That's it. The expected return of a portfolio is just the sum of the expected returns of the individual assets, multiplied by their respective weights in the portfolio.
Let's break down the mechanics of what that actually means without getting bogged down in all the Greek symbols on the page. The inputs are incredibly basic.
They are.
You just need to know how much money you put into an asset and what that asset is expected to yield.
Right. You take the proportion of your total portfolio that is invested in a specific stock. Let's call that the weight.
Okay.
And you multiply it by the expected percentage return of that specific stock. You do that for every single asset in your basket, and then you just add the results together.
Let's apply this to a really concrete example straight from the MBA materials. Imagine an investor, let's name him Oliver.
Okay, Oliver.
Oliver has a simple 2-asset portfolio. He puts 70% of his total capital into security A, which has a historical expected return of 12%.
Got it.
Then he takes the remaining 30% of his capital and puts it into security B, which has a slightly higher expected return of 15%. So, if the exam asks for the total expected return of Oliver's entire portfolio, how do we process that mathematically?
We just treat it as a direct linear relationship. Step 1, we find the standalone contribution of security A.
Okay.
Its weight in the portfolio is 70%, or 0.70. Its expected return is 12%. So we multiply the weight by the return to find its isolated contribution.
Okay, let's do the math. The 70% weight multiplied by the 12% return. 7 times 12 is 84, so that gives us an 8.4% contribution from the first asset.
Exactly. Then we just mirror that exact same process for security B.
Right.
It makes up 30% of the portfolio, giving it a weight of 0.30. Its expected return is 15%. So multiplying the weight by the return gives us its isolated contribution.
Okay, 30% weight multiplied by the 15% return. 3 times 15 is 45, so that gives us a 4.5% contribution from the second asset.
Perfect. The final step is simply adding those isolated contributions together. The 8.4% from security A plus the 4.5% from security B.
Which totals exactly 12.9%.
Right. The expected return of Oliver's entire portfolio is 12.9%.
You know, it behaves exactly like mixing a cocktail.
How do you mean?
Well, if a drink recipe calls for 70% sweet juice and 30% sour mix, the final flavor profile is just a direct proportional blend of those two ingredients. The return of the whole is exactly equal to the sum of its weighted parts. It's a perfectly straight line.
I like that analogy. And that linear nature is exactly why students usually breeze through this part of the exam. If you understand how to calculate a weighted grade point average based on the credit hours of your classes, you already know how to calculate expected portfolio return.
But, and this is a massive warning sign for anyone listening right now, this exact simplicity is a trap.
It is a huge trap.
Return might act like a simple recipe, but risk operates in a completely different dimension. This is the pitfall where so many students lose crucial points on the exam, because they instinctively assume that if portfolio return is a weighted average, then portfolio risk must also be a simple weighted average.
And the foundational texts state unequivocally that it is not.
Why not?
Because while returns simply add together, risks interact with each other.
They interact.
Exactly. The risk of a portfolio reflects not only the standalone volatility of the individual stocks, but crucially, it reflects how those stocks behave in relation to one another over time.
So we need a way to mathematically capture that interaction. But before we get to the interaction part, let's quickly solidify how we measure the standalone risk of a single asset. The literature uses variance and standard deviation, right?
Yes. Variance is a statistical measurement of how far a set of historical returns is spread out from their average value. It basically measures volatility.
Okay.
Standard deviation is simply the square root of that variance. And that's really useful because taking the square root brings the metric back into the exact same units as the return percentages.
So it's easier to read.
Right. A high standard deviation means the asset's returns swing wildly from year to year. It's a very bumpy ride. A low standard deviation means the returns are tight and predictable.
Okay, so that covers the individual bumps in the road. But how do we measure how two different assets bounce off each other? How do we actually quantify that interaction?
The primary tool for this is covariance. Covariance measures the absolute degree to which the returns of two separate assets move together.
Okay.
So if stock A goes up and stock B also tends to go up at the exact same time, they have a positive covariance. If stock A goes up and stock B usually drops, they have a negative covariance.
The problem with covariance, mathematically speaking, is that the final number isn't standardized, is it?
No, it's not.
Depending on the scale of the assets, a covariance could be 0.05 or it could be 5,000. It makes it very difficult to just compare different pairs of assets at a quick glance.
Which is exactly why we rely so heavily on the correlation coefficient. The correlation coefficient takes that raw covariance number and standardizes it. It scales the relationship so it always falls perfectly between negative 1.0 and positive 1.0.
This scale is basically the compass for portfolio theory. Let's map it out for the listeners.
Okay, a correlation of exactly positive 1.0 means perfect positive correlation.
Meaning they move exactly the same way.
Right. The two assets move in perfect lockstep. If one goes up 5%, the other goes up exactly 5%.
Got it.
Now, a correlation of 0 means there is absolutely no statistical relationship whatsoever. Their movements are entirely independent and random relative to each other.
Okay, and the other end?
A correlation of exactly negative 1.0 means perfect inverse correlation. They move in exact opposite directions every single time.
Which is like our umbrella and sunglasses stocks from the intro. Finding an asset with a negative 1.0 correlation is basically the holy grail of risk management, but I imagine it's incredibly rare in the real world.
Extremely rare. Usually assets sit somewhere in the middle of that scale.
Okay, so now that we have our ingredients, we've got the weights, the individual standard deviations, and this correlation coefficient, we have to tackle the most intimidating equation on the exam.
The portfolio variance formula.
Yeah. When you look at the formula for a two-asset portfolio, it just looks like a long, chaotic string of algebra.
It really does.
But if you break it down, it is actually composed of three very distinct, highly logical chunks.
Right. Let's break those down. The first chunk simply calculates the isolated risk contribution of the first asset based on its weight and its variance.
And the second chunk does the exact same thing for the second asset. It calculates its isolated risk contribution based on its specific weight and variance.
Exactly.
And if the formula just stopped right there, at the end of chunk 2, portfolio risk would just be a simple weighted average.
But the formula does not stop there. It includes a massive third chunk, which is entirely dedicated to the covariance. This third chunk multiplies the weights of both assets, the standard deviations of both assets, and crucially, the correlation coefficient between them.
Okay, let me pause you there because this third chunk is essentially the mathematical engine of diversification.
That's exactly what it is.
Because it multiplies everything together, if the correlation coefficient is a negative number, or honestly even just a low positive number, that entire third chunk shrinks the total outcome. You are physically subtracting risk from the final tally.
Yes. It proves mathematically that by combining two volatile assets that do not move in perfect unison, the overall risk of the combined portfolio will be strictly less than the weighted average of their individual risks.
That is wild.
Let's look at the implications of this using the specific data from the textbook.
Okay, let's set the stage with the exam parameters. We have a portfolio split between two assets. Asset A is 40% of the portfolio, and it's relatively safe with a standard deviation of just 5%. Asset B makes up the other 60%, and it's much riskier, swinging around with a standard deviation of 20%. And the crucial piece of interaction data, their correlation coefficient is 0.5.
Right, so they tend to move together, but not perfectly.
Exactly.
Now, if we were naive and just treated risk like a simple weighted average, we would calculate 40% of the 5% risk plus 60% of the 20% risk.
Right.
And that simple math would lead us to expect a total portfolio risk of 14%.
But because we are MBA students who understand the variance formula, we don't do that. We plug the weights, the individual standard deviations, and that zero point 0.5 correlation into the three chunks of the big equation.
Yes.
We calculate the isolated risk of asset A, we add the isolated risk of asset B, and then we add that interaction chunk on the end.
And when you run those actual numbers through the full formula, the total variance drops. Yeah. And when you take the square root of that variance to find the portfolio's standard deviation, the final result is 13.11%.
13.11%. That is the core aha moment of modern portfolio theory right there.
It really is.
The simple weighted average suggested a risk of 14%. But because the correlation was 0.5, because they don't move in perfect lockstep, the actual risk is almost a full percentage point lower. We literally mathematically erased risk just by pairing them together.
And think about this. If we had found an asset with a correlation of 0 or a negative correlation, that 13.11% would drop even further.
Wow.
This mathematical elimination of risk without necessarily lowering the expected return is exactly why diversification is often called the only free lunch in finance.
It's free lunch. I love that. And the math completely proves the free lunch exists.
Yeah.
But to succeed on the exam, you guys need to understand how this mathematical magic trick applies to the messy reality of the real-world economy.
Right.
Which leads us to the concept of diversification and the distinct types of risk. Because, you know, the umbrella and sunglasses scenario we opened with is a perfect simplified example of negative correlation. One zigs when the other zags.
It perfectly illustrates the protective power of diversification. But the curriculum demands that you understand a really vital nuance here.
Which is?
Diversification is incredibly powerful, but it's not omnipotent. It cannot eliminate all risk. MPT explicitly deconstructs total risk into two completely separate categories, and understanding the difference between them is absolutely non-negotiable for the exam.
Okay, let's break down the taxonomy of risk. What are the two categories?
The first category is systematic risk. This represents the massive macroeconomic waves that wash over the entire financial system. It is the variability in returns caused by factors that affect virtually every single firm in the economy simultaneously.
Okay, so we are talking about massive, completely unavoidable forces like an unexpected spike in the federal interest rate, a sudden surge in global inflation, or a widespread economic recession.
Exactly. If the central bank aggressively raises interest rates, borrowing money becomes more expensive for every single company.
Right.
It doesn't matter if you make software, sell groceries, or build cars, your cost of capital goes up. Because these forces affect everyone, the prices of almost all securities tend to move together in response.
You know, I always think of systematic risk like the physical track on a roller coaster.
Okay, I can see that.
Yeah, it doesn't matter if you are sitting in the very front car or the very back car. If the track takes a steep dive, every single passenger is going down. You cannot escape the layout of the track by just changing your seat.
That analogy holds up perfectly. And because you cannot escape it, systematic risk is also referred to as non-diversifiable risk, or market risk. No matter how many different stocks you add to your portfolio, you cannot diversify away the threat of a global recession.
Okay, so that is the risk we are fundamentally stuck with. What is the second category, the one we actually can control?
The second category is unsystematic risk. This represents the fluctuations in return caused by micro-level factors that are unique to a specific company or a specific industry.
Right.
These events happen in a vacuum. They affect one firm without rippling out to affect others.
What does that look like in the real world, practically speaking?
Well, imagine a massive warehouse fire at a specific textile manufacturer.
Okay.
That is absolutely devastating for that one company's stock, but it has absolutely no impact on a tech company in Silicon Valley. Or consider a sudden, unexpected resignation of a beloved CEO, or a localized labor strike, or a pharmaceutical company failing a specific FDA drug trial.
Okay, so returning to the roller coaster analogy, if systematic risk is the steep drop built into the track, unsystematic risk is like having a loose bolt on your specific seatbelt.
That's good.
Yeah, it is a highly localized, unique danger to just one specific passenger.
Yes. And because these events are completely random and isolated, they are not correlated. This is why unsystematic risk is also called diversifiable risk or firm-specific risk. If you hold a portfolio of just 2 stocks and one company has a warehouse fire, your portfolio takes a massive hit. But if you hold a portfolio of 500 different, totally unrelated companies, the negative impact of that one fire is mathematically diluted to almost nothing.
Right. And furthermore, in a massive portfolio like that, the random bad luck of one company is usually offset by the random good luck of another. One company has a labor strike, but another company lands a surprise government contract. They just cancel each other out.
And this canceling out effect is visually represented by one of the most critical graphs in your textbook.
Oh yeah, the graph.
Imagine a chart where the horizontal x-axis represents the number of randomly selected stocks in your portfolio, starting from 1 and moving right toward infinity.
Okay.
The vertical y-axis represents the total risk, the standard deviation of your portfolio.
Okay, I am painting the picture in my head right now. Stocks on the bottom axis, risk on the side axis.
When you only have one stock, your dot is high up on the risk axis. You are fully exposed to massive unsystematic risk. But as you move to the right, as you add 10, 20, 50 stocks to the basket, the line tracking your total risk plummets downward. The curve slopes sharply down.
But it doesn't plunge all the way to 0, does it?
It does not. The downward curve eventually flattens out, forming an asymptote. It levels off and basically rests on top of a horizontal baseline that hovers above 0.
That visual is so crucial for the exam. The massive drop in the curve represents the elimination of the unsystematic risk.
Right.
You literally diversified away the warehouse fires and the bad CEOs, but that hard horizontal floor that the curve rests on, that is the systematic risk. That is the global recession, the inflation, the interest rates. No matter how many thousands of stocks you buy, your risk will never, ever drop below that floor.
Exactly. Understanding that graph and really internalizing the difference between the risk you can diversify away and the risk you simply have to endure is a core competency of modern finance.
All right, let's take stock of where we are in this journey. We know how to calculate our expected return. We know how to calculate our risk using variance and correlation. We understand that by combining assets, we can magically eliminate unsystematic risk.
We've covered a lot of ground.
We have, but this creates a massive practical problem. There are thousands of publicly traded stocks in the world, and there are literally millions of different ways to combine them. So if I want to build the absolute best possible portfolio, how do I navigate millions of options? I mean, I need a map.
And Markowitz provided exactly that map. To build it, he proposed a massive thought experiment.
Okay, let's hear it.
Imagine a supercomputer taking every single risky asset in existence and mixing them into every conceivable combination. 10% Apple and 90% Exxon, 50% Ford and 50% Treasury bonds. Literally every permutation mathematically possible.
That is an almost infinite universe of potential portfolios.
It really is.
Yeah.
Now imagine the computer plots every single one of those hypothetical portfolios onto a massive graph. The x-axis is risk. The y-axis is expected return. When millions of portfolios are plotted, they form a giant, dense cloud of dots.
Just a huge blob.
Right. Economists call this entire cloud the opportunity set, or the feasible set. It represents the total reality of what is mathematically possible in the market.
Okay, but as an investor, I don't want just any random dot in the cloud. Rule number 1 of the sandbox is that I am a rational utility maximizer. I want the absolute best dot. Where do I look on this map to find it?
Well, think about the axis. Risk goes from left to right. Return goes from bottom to top. As a rational investor who hates risk and loves return, you want to move your dot as far up and as far to the left as gravity will allow.
So I want to be on the uppermost leftmost edge of the cloud.
Exactly. If you trace the outer boundary of the top left side of that massive cloud, it forms a distinct upward sloping curve, shaped roughly like a hyperbola. That specific outer boundary line is called the efficient frontier.
The efficient frontier. Man, that is a concept that transcends exams. It is discussed in literally every wealth management office in the world. What is the strict textbook definition that the students need to write down for the test?
A portfolio is mathematically defined as efficient, if and only if it sits perfectly on that boundary line. An efficient portfolio yields the highest possible expected return for a given level of risk. Conversely, it offers the lowest possible risk for a given level of expected return.
So we look at the dots sitting deep inside the cloud, below the efficient frontier. What does the math say about them?
Any portfolio inside the cloud is mathematically suboptimal.
Meaning?
If your current portfolio is a dot inside the cloud, you are acting irrationally. Why? Because you could just draw a straight vertical line from your dot up to the efficient frontier, discovering a completely different portfolio that has the exact same amount of risk, but pays you a higher return.
Right.
Or you could draw a straight horizontal line to the left, discovering a portfolio that pays you the exact same return, but exposes you to far less risk.
To put it bluntly, if you aren't on the efficient frontier, you are leaving free money on the table, or you are taking on unnecessary stress for absolutely no reward. The frontier acts as the ultimate filter. It deletes millions of garbage options and leaves you with a curated menu of the mathematically optimal portfolios.
That is exactly what it is, a menu of optimal reality. But it presents a final psychological hurdle.
Okay, what's the catch?
Well, the efficient frontier is a long, sweeping curve made up of many different dots. Down to the bottom left of the curve, you have a portfolio with very low risk but very low return.
Right.
Up at the top right of the curve, you have a portfolio with massive expected return but terrifying volatility. Both of those dots are on the line. Both are mathematically efficient.
But I only have one bank account. I can
Oh.
only buy one portfolio. If the entire line is mathematically perfect, how do I pick my specific dot?
This is the grand finale of Markowitz's theory. Up to this point, the entire map, the feasible set, the frontier, has been constructed using cold, hard, objective statistics.
Yeah, just numbers.
The market doesn't know who you are. To find your single perfect destination, we actually have to map your unique human psychology onto the mathematical reality of the market.
How exactly do economists graph human personality? That sounds impossible.
They do it through the concept of indifference curves.
Indifference curve.
Yes. We know all investors are risk-averse, but they are not averse to the exact same degree. Think of two completely different investors. One is a 25-year-old tech entrepreneur with no dependents. The other is a 65-year-old school teacher approaching retirement.
Oh, right. The tech entrepreneur might barely blink if her portfolio drops 20% in a single month, but the retiring teacher would be completely devastated by that exact same drop.
Exactly. Their utility, their psychological threshold for financial happiness is drastically different. An indifference curve is a graph that plots the exact combinations of risk and return that provide an investor with the exact same level of psychological satisfaction.
So on a graph with risk on the x-axis and return on the y-axis, what shape does a human personality actually take?
It takes the shape of an upward-sloping curve. Think about the psychology here. If I force you to take a step to the right on the x-axis, if I force you to take on more risk, how do I keep you from being angry? How do I keep your utility constant?
Well, you have to compensate me. You have to give me more expected return on the y-axis to make up for the extra anxiety.
Yes. The curve slopes upward because it represents the exact exchange rate your specific brain demands between anxiety and reward. Any point along that specific curve makes you equally happy. You are mathematically indifferent to choosing any portfolio on that line because the ratio of risk to reward perfectly balances out for your specific nervous system.
And so different personalities have completely different slopes.
Exactly.
The conservative teacher's curve would be incredibly steep, right? Because she demands a massive amount of return to tolerate even a tiny sliver of extra risk.
Right.
While the tech entrepreneur's curve would be much flatter. And an investor doesn't just have one curve, they have a whole series of them stacked on top of each other, kind of like contour lines on a topographical map.
And that topographical map is the key. The higher the curve is placed on the graph, the higher the level of utility. As a rational human, you always want to jump to the highest, furthest left indifference curve possible, because it represents maximum happiness, high return, low risk.
But we can't just float up to an infinitely high curve of happiness because reality anchors us down. The market simply doesn't offer infinite return for zero risk. We are physically constrained by the efficient frontier.
Which brings us to the ultimate solution for the exam. To find the single optimal portfolio for a specific investor, you superimpose the map of their psychology, their indifference curves, directly over the map of market reality, the efficient frontier.
Oh, wow. So imagine sliding your contour map of happiness down from the top left corner, aiming for that rigid boundary of the market.
Exactly. You slide it down until your highest possible indifference curve makes contact with the efficient frontier. The single optimal portfolio is located at the exact point of tangency.
Tangency, meaning the curve comes down and just barely kisses the frontier at one singular microscopic dot without crossing over it.
Yes. If your curve is floating above the frontier, it represents a fantasy portfolio that doesn't actually exist in the real market.
Right.
If your curve slices through the frontier in two places, it means you are settling for a lower level of utility than you could potentially achieve. The tangency point is the absolute pinnacle. It is the highest level of psychological satisfaction you can possibly wring out of the reality of the market.
So if I'm hearing this right, the tangency point is essentially a mathematical compromise.
It is.
It is the perfect marriage between what the objective market can optimally offer and what the subjective investor specifically desires. The 25-year-old and the 65-year-old are looking at the exact same efficient frontier, but because their indifference curves have totally different shapes, they will find tangency at completely different dots along the line.
That is the profound elegance of modern portfolio theory. It provides an ironclad, objective statistical framework for managing risk, but it still retains the flexibility to accommodate the highly subjective reality of human emotion. It bridges the math of the market with the psychology of the individual.
That is a brilliant synthesis, honestly. If you are listening to this right now, cramming for the MBA exam, let's just take a step back and look at the massive intellectual journey you just completed.
It's a lot to process.
We started by exploring the history of Markovitz's 1952 breakthrough, translating the chaos of human behavior into the 6 rigid rules of a theoretical sandbox. We unpacked the linear math of expected return, and then we tackled the really complex reality of expected risk.
We did.
Learning that the interaction between assets, which is measured by the correlation coefficient, is the mathematical engine that makes diversification possible in the first place.
And then we moved from pure math to real-world application, proving why you absolutely must differentiate between the unavoidable gravity of systematic risk and the diversifiable threat of unsystematic risk.
Yep.
Finally, we mapped the millions of market possibilities to find the efficient frontier, and we overlaid human psychology to locate the singular optimal portfolio at the exact point of tangency.
You now have the underlying logic fully mapped out in your head. You don't just have the formulas memorized, you actually understand why the formulas exist and the human behavior they represent. You are fundamentally prepared to ace this unit. But before we sign off, let's push just a little bit past the boundaries of the exam.
Okay, let's do it.
Because the Markovitz model is Nobel-winning theory, but it fundamentally relies on a very specific assumption about time.
It does. The entire architecture of the efficient frontier relies on historical data. It assumes that the historical variance of a stock and its historical correlation with other stocks is a highly reliable predictor of its future behavior.
Right.
In normal economic weather, that is a highly effective assumption. But the real world occasionally produces events that completely break the models.
You are talking about black swan events, these unprecedented, massive systemic crises.
Exactly. Think back to the global financial crisis of 2008. The complex mathematical models assumed that different asset classes, mortgage-backed securities, equities, commodities, were largely uncorrelated.
Right. They assumed they wouldn't all move together.
Yes. They built massive, supposedly optimal portfolios based on that exact historical assumption. But when the housing market collapsed and systemic panic set in across the globe, liquidity just dried up entirely.
And when pure panic hits, rationality goes right out the window. People don't look at variances anymore. They just liquidate absolutely everything they can to get cash. The umbrella stocks, the sunglasses stocks, they all crash at the exact same time.
Exactly. In a true crisis, the historical correlations break down entirely. Suddenly, the correlation between almost every single asset class spikes toward positive 1.0. Everything moves in lockstep downward. And as we learned from the variance formula earlier, when correlation hits 1.0, the magic of diversification vanishes.
It's just gone.
The mathematical protection completely fails precisely when you need it the most.
The map is a brilliant guide, but the map is not the territory. Modern portfolio theory is the most powerful lens we have to view the market, but the future always holds surprises that the math just cannot predict. It's a really sobering thought to carry with you as you transition from the classroom to the actual trading floor. Thank you all for joining us on this deep dive. You've put in the rigorous work, you understand the mechanics deeply, and you are going to absolutely crush this exam. Trust your preparation and go show them what you know.